A new retirement tax rule could save you $186,800, but only if you act before 2029. Starting now, the IRS is letting seniors keep up to $46,700 a year completely tax-free. Yes, every single year, from 2025 to 2028. This isn't a gimmick. It's already law. But barely anyone knows. This new policy was passed quietly by Congress earlier this year. It permanently locks in lower tax brackets. But more importantly, it gives Americans over 65 a massive new deduction, and opens a 4-year window to legally avoid taxes on a huge portion of retirement income. If you're 65 or older, or even getting close, this video could change how you think about retirement. Because this rule isn't permanent. And if you don't plan ahead, you could lose a 6-figure tax shelter. Let's break down what this law actually does, how to use it wisely, and why July 2025 marks a critical turning point for retirement tax planning in the United States. What was supposed to happen in 2026? Before this law passed, we were headed for major tax hikes in 2026. The Trump-era Tax Cuts and Jobs Act was set to expire. And that would have reversed nearly every break retirees had been using. The 12% bracket would have jumped to 15%. The 22% bracket was going back to 25%. And the 24% bracket would have shot up to 28%. These changes were baked into the original 2017 law. In addition to higher brackets, the standard deduction would have shrunk significantly. Personal exemptions would return, yes, but not nearly enough to cancel out the loss. This was expected to raise taxes for over 60% of American households. In short, most retirees would have ended up paying thousands more, especially those living on fixed incomes, pensions, or retirement distributions. That fiscal cliff was coming in just 6 months. But then Congress changed the game in 2025. In early 2025, a surprising compromise led to one of the most senior-friendly tax changes in decades. It didn't just extend the 2017 cuts. It created something brand new, a senior bonus deduction. This deduction stacks on top of everything else. That includes the standard deduction, the age-based bump for being 65 plus, and any existing tax credits. And when you add it all up, the result is dramatic. Married couples over 65 can now earn up to $46,700 per year in completely untaxed income. That's every year from 2025 through 2028. Total tax-free income over 4 years? A stunning $186,800. And that's before you even factor in other tax strategies like Roth conversions or capital gains harvesting, which can stretch this benefit even further. But there are limits you need to know. How the $46,700 deduction breaks down. Here's how the math works for a married couple over 65. Start with the new standard deduction, which is now $31,500. Then add $1,600 per spouse as the senior age bonus, that's $3,200. Now comes the big one, a brand new $6,000 senior bonus deduction per person. That's another $12,000 on top. Put it together, and you get $46,700 in fully tax-free income, no itemizing required. For single seniors, it's still powerful. You get a $17,750 deduction plus the $6,000 senior bonus, totaling $23,750. This applies even if your income comes from Social Security, retirement plans, or side income. But this deduction isn't unlimited. There's an income cap where it begins to phase out. And if you're not careful, you could lose it. Income phase-outs and why planning ahead matters. Once your adjusted gross income, AGI, hits $150,000 as a married couple, or $75,000 if you're single, the senior bonus deduction starts to phase out. It disappears gradually, based on how far above the threshold you are. This is why tax planning is key. The difference between earning $149,000 and $151,000 could cost you thousands in lost deductions. Since it resets annually, you need to manage income flows year by year. That includes things like when you take IRA withdrawals, how much capital gains you realize, or even when you start Social Security. Smart timing can protect your deduction and help you stretch every retirement dollar. A real example, married couple, both age 66. Let's say you and your spouse are both 66. You have $100,000 in combined retirement income, including pensions, Social Security, and maybe some part-time income. Under the new rule, you subtract $31,500 for the standard deduction. Then $3,200 for the senior age bonus. Then $12,000 for the new senior bonus deduction. You're now down to just $53,300 in taxable income. That means $46,700 of your money was completely shielded from tax. And if you have investment losses or credits, you might owe even less. Now multiply that over 4 years. That's nearly $187,000 in untaxed income, enough to cover years of living expenses, travel, or medical costs without touching your savings. Why these 4 years matter so much? Here's the catch: this benefit disappears after 2028. It is not permanent. If Congress doesn't renew it, the senior bonus deduction will vanish, and tax brackets could rise again in 2029. These next 4 years are a sweet spot. You're not yet required to take minimum distributions from retirement accounts. Tax rates are at historic lows. And you have control over when and how you recognize income. This is your chance to convert taxable money into tax-free money. Because once 2029 hits, the game changes again. And most retirees will be back to paying higher federal taxes. Smart moves to make before 2029. The smartest retirees won't just enjoy the deduction, they'll use it to shift their entire retirement strategy. Here's what you can do now to maximize the next 3.5 years. First, consider Roth conversions. If you're under the AGI limit, you can convert part of your traditional IRA each year and still stay tax-free. That means tax-free growth for life and zero RMDs later on. Second, look at capital gains harvesting. If you own appreciated stocks, selling while in a low bracket could result in zero capital gains tax. Then you can reinvest at a higher cost basis for future years. Third, withdraw from IRAs before RMDs kick in. That lets you smooth out your tax brackets, avoid Medicare premium hikes, and reduce future taxable income. It also gives you more flexibility if tax rates go up after 2028. And finally, track how this affects Social Security and Medicare. Unplanned withdrawals could make your benefits taxable or raise your premiums. So coordination is everything. Think ahead, not just year to year. What if you're not 65 yet? If you're still in your early 60s, don't tune out. You can still benefit by laying the groundwork now. These next few years are perfect for planning ahead and optimizing your future deductions. By converting IRAs slowly, you can lower your taxable balances before RMDs begin. By harvesting gains now, you can reduce future capital gains exposure. And by staying below income thresholds, you keep doors open for future benefits. If you turn 65 in 2027 or 2028, you still qualify in time to benefit. But you need to position yourself now, before the window begins closing. Quick recap: what just changed? Let's bring it all together. A new law passed in 2025 allows seniors to shield $46,700 a year, tax-free, until the end of 2028. That includes standard deductions, age bonuses, and the new senior bonus deduction. This creates a $186,800 tax-free opportunity over 4 years. But only for people who manage their income wisely and stay under the AGI limits. It's a once-in-a-generation tax window for retirees, and it's already halfway through year 1. Final thoughts: don't wait until the door closes. This tax break is real, powerful, and already in effect. But it only works if you act during the short window Congress gave us. Don't assume it'll be extended in 2029. It may not be. For retirees and those nearing retirement, this is your moment. A chance to reduce taxes, preserve savings, and control your future. The sooner you move, the more you keep. And if you ignore it, you might wake up in 2029 with higher taxes, fewer deductions, and missed opportunities you can't get back. If you found this helpful, don't forget to like, subscribe, and turn on the bell icon for more updates like this. Thanks for watching. We'll see you in the next one.